All right, in this lesson we're going to revisit a topic that we talked about before. The reason that we're going to revisit this topic that we've talked about before is because as an auditor you really need to understand this concept, because this is kind of how we get our work accomplished, how we get it done at the end of the day. Now you might be saying, what's this topic? Well, this topic is materiality. We're going to look at materiality again because at the end of the day for auditors it is the most important thing to help them navigate what they need to look at, what they don't need to look at, and kind of save time and a little bit of money for our clients so that they're not overpaying for something that doesn't give them benefit or doesn't give the investors benefit at the end of the day. So we're going to look at materiality here. We're going to revisit a little bit about what materiality is, and then we're going to kind of guide you on what things we're doing as an auditor from a materiality standpoint. And then in future videos or future lessons, we're going to really talk about how we apply materiality to specific things that we do as auditors. So again, we're kind of building on this idea of what materiality is. This will give you a little bit more about materiality. And then in future lessons, we're going to go over materiality when we talk about individual tests. Okay? So what is materiality? Let's refresh a little bit on what we learned in a prior lesson. Materiality is information becomes material if omitting it or misstating it could influence the decision that users make on the basis of the financial information of a specific reporting unit. So we said before that materiality is basically what would change the decision of the person who's reading the financial statements. So the example that we've used before is what would happen if we gave $100 to a college student, 5 minutes later they lose it? Does that change their decision? Does that change their demeanor because they've lost $100? And we'd probably say yes, because that college student isn't making a ton of money right now. They're taking a lot of loans out. So that $100 would get them far at the end of the day. So that $100 is material to them. Now we can flip the coin and give $100 to a millionaire, and that millionaire goes walking down the street, puts it in their pocket, pulls out their keys to their car, drops $100, doesn't realize it, goes off on their way, figures out they've lost $100. Do they change their demeanor? Do they change their decision because of it, and are they mad about it? They may be a little bit mad, but they still have $1 million, so they can afford it. Now, does it change their decision on what they're going to do? Probably not, because that $100 is not a lot of money to them, and it doesn't change their the way that they spend because of that $100. So that $100 to that millionaire is not material at all. So when we look from it from a financial standpoint, we're looking at a company and we're saying, okay, they've got $5 million in net income. Is $100,000 material for that company? Is $1 million material for that company? Is $10 material for that company? We might say that for that $5 million company that $100,000 is material, which means anything below $100,000 is not material, but anything above $100,000 is material. Now take that with a grain of salt. We're going to talk a little bit more about that. It isn't just 100,000. There's more to it. But to kind of give you a very simplistic idea of what we're talking about, you know, anything under $100,000 in account balance, let's say, we're not going to audit them because as a whole, it doesn't make sense to audit cash when cash is only $50. We don't really care. That's not material to the overall financial statement. Okay? Now, why are we doing this? Well, we're doing this, or we're learning about materiality because we want reasonable assurance. Reasonable assurance that the information in the financial statements are correct and accurate as of the date of the balance sheet, blah, blah, blah. Okay? Now, you might even ask, okay, we want reasonable assurance, but why can't we have something called absolute assurance? The reason why we can't have absolute assurance is because of a constraint that we learned in financial accounting. In financial accounting, you learn something called cost versus benefit. Okay? So a constraint that we have is the cost of doing it versus the benefit we would get out of it. So for instance, let's say that we do our audit and we get a 95% confidence level. We're 95% sure that the financial statements are accurate. Okay? We're okay with that 95%. Let's say to get to 95%, it's going to cost our firm $1 million to do that audit, or it's going to cost the client $1 million to do that audit. Okay? But if we wanted to go to 100%, which means that we're going to go from reasonable assurance to absolute assurance. To get to absolute assurance, it's going to cost us 10 times more to go that extra distance of 5%. So just to go from 95 to 100, it's going to cost 10 times more, $10 million. The question that we're going to be asking ourselves from a cost versus benefit Is it worth it to the client to get a 5% more of assurance that everything is absolutely correct and then charge them $10 million, knowing that the firm's profit was $15 million? Well, that's 2/3 of their profit, and that's not appropriate at the end of the day. Okay, so cost versus benefit. The other thing that I can equate this as an example, think about a big organization that might do 100, we're going to use this just to be easy on the math, but let's say they do 1 million transactions in their accounting books, so 1 million journal entries into their books every single day. In a year's time, that's 365 million transactions that would have to be reviewed. If we wanted absolute assurance, we'd have to look at every single one of those transactions. To look at every single one of those transactions, you got to ask yourselves, how many people do we need in the engagement? How much is that going to cost us? And how much time would we need to complete that? You would probably say, we can't. I mean, 1 million transactions a day, we would have to be there year round. We would probably have to have 5,000 people just looking at every one of the transactions, because there's just so many transactions that have to be looked at and reviewed and done that it's not even worth it at the end of the day, because it's going to cost our clients $100 million just to look at every single transaction. And so the cost to get to that next 5% doesn't matter at the end of the day, because it's going to cost us too much and it's not going to be appropriate for the client. So cost versus benefit. That's why materiality makes sense. Now, materiality itself has to do a lot with an accountant's professional judgment. What do we mean by professional judgment? We talked about 2 examples, right? $100 for the college student, $100 for the millionaire. But the millionaire obviously is a millionaire, so that materiality will go up. So maybe for them, material is $150,000 because they're a multimillionaire. Okay. Well, the question is, how do we know it's $150,000? I mean, what do we use to get to $150,000? What numbers do we use? And that comes down to professional judgment. So based on an accountant's experience, based on the particular client's dealings, based on the particular client's loans covenants, based on the client's financial situation, that's going to help us determine what materiality number is going to be right for them. Okay? Now there's 3 things that we need to learn with materiality. The first thing is that we're going to have to determine what we call overall materiality. What is overall materiality? Overall materiality is a number that's set for the materiality of the financial statement as a whole. Okay? So if we're looking at a $10 million company, let's say $10 million in profit, then we would set a materiality based on a percentage of the profit. Now typically we're looking between 2 to 5% of earnings before taxes as far as what materiality is going to be. So let's just say, for the ease of math, I'm going to use the ease of math, let's just say it's 10%. So on a $1 million company, materiality, overall materiality on all the financial statements in itself would be $100,000, 10% of $1 million net profit. Okay? If it was 5%, then it would be $50,000. So for that company, it would be $50,000. So $1 million is their net profit. 5% of that is $50,000. Maybe it's 10%, so it's $100,000. That's materiality. That's the overall materiality on the entire financial statement as a whole, taken as a whole. So what happens when we do all these tests, we aggregate all of these materiality in the statements that we're finding, and we see, okay, when we add them together, is it above or below the determined overall materiality? Now, we do this materiality prior to actually doing any testings, because we don't want to, move materiality up when we start to see more and more mistakes. Okay, so overall materiality kind of gives us the overall material. What are we okay with on the financial statement as a whole? Now, the next thing that we would do from that is we would determine tolerable misstatement. Now, tolerable misstatement is a type of materiality at the end of the day. What it tells us is that if I'm looking at an individual test, what's the materiality for that test, specific test, or specific account balance? So we're not looking at the overall materiality necessarily. We're going to kind of, if this makes sense, divide this overall materiality into different sections to see, okay, if we test cash balance, the materiality for cash balance is $3,000. So instead of 100,000 or 50,000 that we used here, it's 3,000 for cash. So if cash is over by 3,000, or if our testing shows that it's over or under by 3,000, then we're going to have to figure out something, or we're going to have to request a journal entry be put into their books to bring that down or bring that up so that it's at an appropriate tolerable misstatement level for us, okay? Now, one thing to note, we're not going to get too deep into this, is that typically what happens is overall materiality will be set for, let's say, 100,000, and then an accounting partner or senior or manager will say, okay, tolerable misstatements would be, I don't know, for cash, 50% of overall misstatements. So now you have $50,000 for cash. And then they might go, okay, AR is going to be 50%, so that's 50,000. And then AP is going to be, let's say, 60%, so 60,000. What you're going to notice is we're not necessarily going to divide this up so that it equals $100,000. So when we talk about tolerable misstatements, typically it's a percentage of the overall materiality, but it's not necessarily so that we add it up to 100%. Notice this, if we're just looking at 3 balances, we're already $160,000 as far as total materiality, but this is 100,000. That doesn't make sense. It doesn't make sense because at the end of the day, we don't expect every single balance to have a material misstatement up to this amount. Okay, so for instance, this cash balance might be materially misstated by 40,000, but like this is materially misstated by 2. This is materially misstated by another 2. So now we're at 44. That's still under my 100,000 materiality. So one thing that's usually confusing for students is they'll look at tolerable misstatement and they go, wait, if cash is 50, AR is 50, and AP is 60, that's 160. That doesn't make sense because it's over the overall materiality. Typically, it usually is because it's always a percentage of this. It's not necessarily a division of percentages based on the entire financial statement. Okay? So, and then the third thing that we have to think about for materialities, then or the step that we would do is evaluate the audit findings. So we would look at the audit findings. Typically, what we would do is we would look at all of our audit findings against the tolerable misstatement. And then when we're done with the audit, we're going to look at all of our misstatements against the overall materiality. Hopefully, by the time we look at the overall materiality, we have suggested that certain journal entries are made into the books so that we can bring down the balances to an appropriate level in which satisfy our testing for our purposes. And at that case, when we start to evaluate our audit findings against overall materiality, they would be below that. And because they're doing our journal entries, they would be below tolerable misstatements, each account or balance or however we're using that. And at the end of the day, we can issue a clean opinion because of that. Some clients may say, no, we're not going to do that, and then that's just what we have to follow. They're not going to do that. But then that also could possibly affect the overall materiality, tolerable misstatements, and at the end of the day, the actual opinion that we write to them at the end of the audit engagement. So again, this is kind of building on what you know about materiality. Remember, materiality is stated as what would change the decision or make a difference in the decision that the user of the financial statement would normally make. If they are going to make a different decision because they have an omitted number, then it becomes material. However, if we're talking about pennies and cents, it may not be material to them. That's often why on financial statements you don't see pennies and you don't see dollars. They round them off because it's not material to the user of the financial statement. At the end of the day, from a materiality standpoint, we're going to look at 3 things. We're going to look at the overall materiality. We're going to set the overall materiality based on typically on a percentage of the net profits. There's other ways to do that. We can talk about that later. But we're going to set overall materiality. Then we're going to set a tolerable misstatement. Tolerable misstatement is for individual accounts or amounts or balances or tests that we do. Usually it's a percentage of materiality. Once we've done that, we'll do our testing, and then we'll evaluate our testing, our audit findings to overall materiality and tolerable misstatement. So again, this lesson was all about materiality and how materiality affects our audit findings at the end of the day.